With assets surpassing $10 trillion, BlackRock stands as the largest asset manager in the world. To illustrate the magnitude of this figure, imagine stacking $100 bills. $10 trillion would create a tower around 10,000 kilometers high, about 25 times the altitude of the International Space Station's orbit. To match the weight of $10 trillion in $20 bills, it would take approximately 83,333 elephants weighing about 6,000 kilograms. With such immense wealth comes significant power, prompting a crucial examination of whether BlackRock's enormous size and influence pose more risks than benefits to global financial stability. Unlike other asset managers, BlackRock has a standout feature that sets it apart: the Aladdin platform. This isn't just any tool, it's a sophisticated integrated investment system that combines risk analytics, portfolio management, and trading on a single platform. Aladdin is used not only to manage the vast assets of BlackRock, but also by other investors, including pension funds, insurers, and even rival asset managers. The platform's reach and capabilities mean that it influences over $21 trillion of managed assets globally, which is a testament to its penetration and impact in the financial markets. But Aladdin's role goes beyond typical asset management functions. It is also a predictive engine that can analyze vast data sets to forecast market trends and potential risks, effectively allowing BlackRock to preempt market shifts and adjust strategies in real time. This capability gives BlackRock a unique vantage point from which it can not only observe but also influence market dynamics. For example, by predicting a downturn, BlackRock can reallocate vast sums across its portfolios, potentially moving the market itself due to the sheer volume of assets managed. This brings us to a critical question. What happens when one company holds the key to so much financial power? BlackRock's dominance, facilitated by Aladdin, places it in a position where it can potentially manipulate market trends simply through the scale of its asset movements and the strategic insights gained from its advanced analytics. This power to sway markets comes with significant responsibilities and raises concerns about market fairness and transparency. Critics argue that with such power, BlackRock could have an outsized influence on market outcomes, benefiting itself and its clients, potentially at the expense of smaller investors who do not have access to similar tools or insights. Moreover, this concentration of market intelligence and control could lead to a form of informational monopoly, where one firm's decisions affect the entire global financial landscape, tipping the scales in ways that could impact financial stability and economic fairness. Founded in 1988 by Larry Fink along with his partners, BlackRock began its journey in a single room with no furniture, signifying their humble beginnings but ambitious plans. The founding team had a clear vision: dominate the risk management sector and finance, a field that was just starting to capture the attention of Wall Street following the stock market crash of 1987. Larry Fink, having experienced significant losses due to mispriced bonds at First Boston, was driven by the vision of creating a firm that wouldn't just manage assets, but would also master the art of risk avoidance. This led to the development of their proprietary platform, Aladdin, which combined risk analytics with portfolio management, a groundbreaking move at the time. As BlackRock grew, its strategy focused aggressively on expansion through acquisitions. It systematically absorbed its competitors, starting with smaller asset managers and moving on to significant entities such as Merrill Lynch Investment Managers in 2006 and Barclays Global Investors in 2009. Each acquisition wasn't just about growing larger, it was about integrating these companies' assets and technologies under the BlackRock umbrella, enhancing its capabilities and influence in the global market. This approach allowed BlackRock to rapidly scale its operations, shifting from a modest asset management firm into a global financial titan. As they grew, their influence permeated deeper into the financial markets, allowing them to set standards and influence decisions that affected not just investments but the very fabric of global finance. By strategically positioning themselves at the center of financial flows worldwide, they reshaped their identity from a risk management company into a global behemoth with the power to dictate market outcomes. The 2008 financial crisis marked a pivotal chapter for BlackRock. As markets crumbled, BlackRock emerged as a savior, advising distressed banks and governments. However, this period also spotlighted its capability to leverage crises to cement its market dominance, often at the expense of market competition. In the wake of the 2008 financial crisis, BlackRock's strategic positioning allowed it to not only survive but thrive, as its asset pool exploded in size. The company's involvement in critical financial recovery measures, such as managing distressed assets for governments and large financial institutions, catapulted it to the forefront of global finance. With each crisis, from the dot-com bubble to the mortgage meltdown, BlackRock has been increasingly seen as a key player in the stabilization and restructuring of markets, gaining unprecedented access to decision-making tables worldwide. This access wasn't just a testament to their financial acumen, but also a gateway to wield significant influence over economic policies and corporate strategies across the globe. With a majority stake in countless companies through its vast portfolio of investments, BlackRock has the power to sway decisions on corporate boards, pushing agendas that align with their interests. This influence is particularly potent because their stakes in companies often make them one of the largest, if not the largest shareholders, giving them considerable clout in everything from executive compensation practices to strategic direction. This rapid expansion and accumulation of influence, however, raised alarms about the concentration of economic power in the hands of a single entity. Critics argue that BlackRock's ability to dictate terms and influence major corporate and economic policies could lead to a homogenization of corporate behavior that prioritizes profitability over innovation. Moreover, with such control, BlackRock can drive the adoption of practices and standards that may benefit its own bottom line, potentially at the expense of smaller shareholders, competition, and even broader economic stability. As BlackRock's influence grows, so does its ability to shape global financial landscapes and economic outcomes, propelling their own agenda onto the world stage. This concentration of power brings into question the checks and balances that are supposed to prevent any single entity from having too much influence, highlighting a systemic risk to the global financial system traditionally associated with banks, now emerging in the realm of asset management. One of the most telling examples of BlackRock's ability to dictate corporate decisions occurred with their involvement in the operations of ExxonMobil. In 2021, BlackRock played a pivotal role in a shareholder revolt that led to a significant shakeup in the oil giant's board of directors. ExxonMobil, one of the world's largest publicly traded oil and gas companies, had been under pressure to address its environmental impact and strategy towards green energy transition. BlackRock, holding a significant stake in ExxonMobil, leveraged its position to push for more aggressive action on climate change, reflecting its broader agenda of promoting sustainable investment practices across its portfolios. The asset manager supported a small activist hedge fund, Engine No. 1, which argued that Exxon was not doing enough to prepare for a world where fossil fuels would be less central to the energy mix. The culmination of this pressure was the election of 3 new board members proposed by Engine No. 1, against the wishes of ExxonMobil's existing leadership. This was a clear demonstration of BlackRock's influence. Not only could they advocate for change, but they could also enforce it by rallying other shareholders and changing the very composition of the board. This move was seen as a landmark event in corporate governance, particularly for the energy sector, highlighting how institutional investors like BlackRock can push significant environmental and strategic shifts at major corporations. The aftermath saw ExxonMobil accelerating its efforts towards sustainability, with increased investments in renewable energy sources and clearer commitments to reducing carbon emissions. This case not only underscores BlackRock's influence over corporate strategies, but also raises questions about the extent to which such power should be wielded by a single financial entity, especially one that as a policy promotes responsible corporate behavior through its investment strategy. BlackRock's impact on corporate decisions is evident in its involvement with Starbucks. As a major shareholder, BlackRock utilized its influence to push Starbucks towards more robust corporate social responsibility initiatives, particularly concerning diversity and environmental practices. In 2020, amidst a heightened focus on social justice issues globally, BlackRock was instrumental in urging Starbucks to enhance its diversity and inclusion efforts. This came at a time when businesses were increasingly expected to take a stand on social issues and implement more comprehensive diversity policies. BlackRock's push aligned with its broader agenda of promoting sustainable and responsible business practices across its investment portfolio. The result was Starbucks announcing a series of ambitious diversity goals, including commitments to increase representation of people of color in corporate roles and tying executive compensation to success in meeting these inclusivity targets. Starbucks also accelerated its environmental initiatives, setting a goal to become resource positive, giving more than it takes from the planet by 2030, which included reducing carbon emissions, water use, and waste. These changes at Starbucks not only demonstrated BlackRock's ability to influence corporate policies, but also highlighted how institutional investors can drive significant social and environmental change. Through strategic use of their shareholder power, BlackRock reinforced their ideas onto a mega company like Starbucks seamlessly. Today, BlackRock stands at the forefront of global finance, not just as an asset manager, but as a potent political and economic force. The future likely holds more growth for BlackRock, but at what cost? The potential for misuse of power and conflict of interest continues to loom large. While BlackRock's meteoric rise is a story of financial success, it is also a cautionary tale of power in the hands of few. As they continue to shape global finance, the line between managing money and controlling economies becomes increasingly blurred. Hit that like button if you found today's video insightful, and don't forget to subscribe for more deep dives like this. Drop a comment below on your thoughts about BlackRock's influence. Do you think they need to be stopped, or is what they're doing just a byproduct of what comes with so much wealth? More and more power. Let's discuss in the comments. See you in the next one.